And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. I get nuts.
With your host, Phil Grande.
Bye. Welcome to my podcast. Well, a lot of things are going on right now in this market and the economy. We have consumer confidence is down big time. We haven't seen consumer confidence this low from 2014. Also, retail, they're hurting. The retail stores, they're not doing well at all. But also what's interesting is on the 20th or the 23rd of February, finally, the Supreme Court should rule on Trump's tariffs. Now, what's going to be interesting about that? Gold is going to do well. Regardless, if Trump loses or wins, gold is going to rally. Why? Because in both cases, win or lose, uncertainty is going to increase. Expectations about inflation is going to increase. In both cases, the dollar is going to decline. That's going to bring all the buyers in for gold, especially foreigners. So this is going to be once in a lifetime where you can win in gold by just buying it because it's going to go up either way. Now, as far as what's going on in the market, you know, it's always the case where Wall Street is always putting optimism out there. And they always show the stock market as a sundae with a cherry on top, when it's a bunch of dog poop. And right now, the market and the economy is nothing but dog poop. It's the best way I could describe it. Now, to find out the truth, what Wall Street doesn't want you to know is that they'll never talk about why the small mid-cap stocks are important, why Russell 2000 is important, symbol IWM. But before I get to that, I want to show you about gold. A lot of people are going to get hurt into gold stocks right now because they're starting to buy them now before the decision. Let's go to my gold chart just for a moment. So if we take a look at my stock and we take a look at, let's take a look at GDX just for a moment. Now what you can see is this. We had the pullback in the miners, GDX. We had a pullback also in Barrick. And here, let's just use this one. We had this pullback. Now it's rallying. And what's happened is all the tourist investors, all the buy in the dip investors, all jumping in. What they don't realize is that they're going to start making new lows. If you look at GDX, now we've been in GDX since January 2024, and we've had returns up to over 70% on that already. But here's the point. You see how when it pulled back, the buy on the dip start jumping in. They don't know what they're doing. And the reason that it's going to make a new bottom is because, again, you can see the trend. The trend is down. The trend is your friend. And the other thing, every morning when the gold stock opens, and you look at the opening high on the stock, on the candlestick, or the opening low, it's always breaking to the downside. It's not holding the highs, and it's not making, you don't see, buying coming in. And many times you start seeing where they'll open on the high in the morning and they break the low. And if you see that consistently, that's telling you there's a problem for that stock. We just don't have volume. We don't have volume. So pricing is always important to look at first in the morning. If it can't hold its pricing, then you go look to the volume. You'll see the problem is in the volume. Then you go look. Lastly, it's stochastic, which gives you trend, and there's a problem with the trend. So these are head fakes, and they could hurt you. The only way it won't hurt you if we get a big amount of buying coming in between now and the time that they announce the Supreme Court what's going on with their decision on tariffs. But let's get back to another thing we're seeing is Wall Street won't talk about IWM, small and mid-cap stocks, the Russell 2000. It's a truth serum, just like yields are a truth serum. So IWM is 2,000 stocks, and you open up the hood. The beautiful thing about IWM, you open up the hood, and you see everything that's going on Main Street. And you can tell if Main Street is slowing down. And we can see that right now. Main Street is slowing down. And we can see that with the terrible retail numbers we just got. And it will show weakness. And also what happens is when you have low consumer confidence, it hits IWM first. And then it hits the credit spread second. So when you look at IWM, you're looking at the hood, under the hood, and it's telling you we got a problem. And then the next thing, when you hear the low confidence, consumer confidence, that bleeds into IWM, bleeds into credit spreads, and there you have it. So you know that the economy is slowing, but nobody wants to tell you that. Nobody ever tells you that IWM is the best place to look if you really want to know what Main Street is doing. I mean, we get lied to all the time about sentiment, about jobs, about how industrials are doing. Everything, your retail sales weaknesses at IWM, your Main Street slowing is in IWM. Everything you need is there. And also the AI stocks that are driving everything, it will disrupt IWM when all of a sudden you get all the financials aren't good, meaning that we're not getting good returns. We're putting billions and billions of dollars into these data centers and into equipment and so forth. And investors aren't getting any returns. They're getting huge amount of investment with tiny, almost nothing returns. So your retail shows up, that's bad. Your Main Street's weak, that's bad. Your jobs, that's bad. And your AI that's driving all the big tech stocks, that will identify when IWM goes down, there's something wrong there. So everything is in one place, IWM. So you have to look at IWM, okay? And that will help you, because when you listen to the jibber jabbers on these TV stations, on these TV financial shows, they're just bold-faced reading cue cards, and everything in that cue card is built on optimism, which is a bunch of nonsense. So when small caps are lagging, IWM is not confirming the strength of the Dow, of the mega caps, of the S&P. They're not confirming it. They're telling us right now that it's not going to break out. This market's having trouble. It has a negative divergence. When you look at IWM, you look at the S&P, you look at IWM, you look at the Dow, there's a negative divergence. So anytime the IWM lags behind your S&P, behind your NASDAQ, behind any of those, okay, it tells you the rally's very narrow. It's fragile. And it's dependent on a couple big names in AI. So the next time you look at IWM and you see it pulling back, it's telling you something's wrong. But Wall Street will never tell you that. They're nuts. They're not going to be truthful to you. And it's the same thing, and to back that up. See, what I'm trying to get at is there's no such thing as being surprised. Oh my God, the market's going down. Oh my God, look at the correction. No. I remember in 1987 when I came back from lunch, everybody was going nuts. Look at the market's down. Oh, we didn't see this coming. That was in October 1987. We started to short stocks in January of 1987. In fact, January of 1987, I started to predict that the market was going to collapse. And the same thing we're seeing today is what we're seeing back then. So, and the higher yields, you got to watch those yields, because when you got higher yields, that means, and we see that every day, okay, recently. And when yields are going up, it's telling you that we got the court decision worries we just talked about. We got the tariff unrest. We got the geopolitical issues. We got this Kevin Warsh. What is he going to do when he takes over head of the Fed? We got problems with Europe and Japan and Iran. All that stuff, okay, is that's what's pushing the yields up. Now we had a little breather where the yields started to come down, but they're not coming down enough, okay? And right before a crash, yields will drop, okay? And again, it's truth serum. It tells you really what's going on, and again, the credit spreads, that will tell you. So if you have the investment grade spreads, and they're at 150, and they start passing 150 and racing towards 200, that will trigger a crash. If you have high yields, okay, spreads, and you look at those and they're at 300 or under, that means there's no stress. But once they start going from 300 racing towards 500, you got a problem. So investment grade spreads, 150 to 200, you're going to have a trigger a crash. High yield spreads from 300 racing to 500, you're going to have a crash. So my point is, you have everything you need to warn you about the direction of the market. There's no such thing as, oh my God, look at this correction, I never thought. Oh my God, look at the crash, I never thought. Are you kidding me? What are you, nuts? You got, in between IWM, between the yields, I mean, you got everything you need that sends out warning signals. And as long as you watch your spreads, your IWM, those are two of the best. You're going to be just fine. Now, the other thing that's going on is that everybody that's in 401ks right now, they're singing songs. They're all happy. They're singing songs around the fire, okay? Just like the Indians used to do. And everybody's happy. They're going to get killed. They're going to get killed. Just like people are buying gold stocks right now because we got this surge, a little surge. It's only a snapback because the trend is still going down, and Wall Street won't tell you that. But the 401k, okay, they're going to get smoked. I mean, I never seen, it's interesting. 401k was failed experiment before it even took off. The only way they could get people to buy 401ks is to throw in, well, we'll match you. And the match is a joke because your fees, your hidden fees, the fees you already know about, wipes out that participation, okay? So, again, there's a reason why people are excited right now because it looks like 401ks, you're rich. But remember, your only return you get in a 401k, a true return, is not as advertised, 5 to 8%. That is a bunch of dog poop. It's 3 to 5%, and most of it is usually 3 to 4%, the real returns. So, as opposed to the spiders, which is 8 to 10%, and mostly 10%. So spiders, real world, 10%. 401k, real world, about maybe 4.5%. I mean, it's awful. And boy, when the markets start going down at some point, you got to just sit there and grind it out. You got to, because there's no mechanisms at all that will release you from the crisis. You can't short. But we can show you how to hedge. So if you're in a 401k, you can protect yourself. And again, people run to these annuities, which are just stupid. These annuities are a joke. I heard one this morning on the radio. Do you know if we can make sure that you never lose money on the way down? Never lose a nickel, but you only make money on the way up. That is total crap. What are you, nuts? That's a lie. It's not true at all. It's a fraud. Because what they should say is this. I'm an insurance company, and we love money, and we are really greedy, and we're going to screw you. But here's what we're going to tell you. You're not going to lose any money when the market crashes like in 2008 or 2000. You're not going to lose money, and you're going to make all this money on the way back up, and we're going to sell you an insurance policy. But the problem is, they're right. You're not going to lose money on the way down. But when they take your money, invest it on the way up, they get 95% of that 20% gain or that 30% gain. Look, Wall Street are a bunch of thieves, but you can make a lot of money on Wall Street if you know what you're doing. That's why we've been teaching for 28 years.